Good evening, everybody. It's 6 o'clock, so we will get going in just a minute. There's a couple of bits of housekeeping first. So, firstly, if you want to submit any questions, if you subscribe to the YouTube channel, you should be able to just type a question in the chat, and Kieran and myself hopefully will answer those at the end. The other bit is, if you haven't already, if you point a camera or type this URL for bit.ly/TG McCloud triage, you can download and print this. And then if you haven't gone through the triage stage of your RPSS, you can do that at the same time as we do it. So just before we dive in, I'm just going to introduce my co-presenter, who's Kieran Hancock. So I'll let him introduce myself, and then I'll introduce myself.
Yeah, hi everyone. Nice to speak to you. As Tony says, my name's Kieran. I'm a specialist medical accountant at Forvis Mazars. When it comes to it, we'll sort of talk a bit more about our service and what we offer later on, as well as a bit of a background to Forvis Mazars. But essentially, I've been in the medical accountancy profession for about 10 years, and I'm a board member and director of AISMA, which is the Association of Independent Specialist Medical Accountants. So really looking forward to speaking to you all, answering some of your questions, and hopefully you'll leave today knowing a bit more about the McCloud remedy and what to do next if you've got a statement that's landed on your doorstep.
Fantastic. Thank you very much. I had a bit of an echo there. I don't know whether there is an echo, so I've just asked my daughter or wife just to text me. So I'm just going to mute you for now, Kieran, and then I'm just going to go back to the slide screen, hopefully. Great. So let's just do a little bit of a whistle-stop tour, starting with kind of pension taxation, because I think it's quite important to understand the basics of what pension taxation is, to be able to understand the information on an RPSS. And then we're going to go through my RPSS as an example, and triage, and then Kieran's going to explain a bit about the service, and then I've got a couple of pre-submitted questions, and then if there's any more questions from the chat, we will answer those in due course. So I'll just advance the slides. So we're going to start off with what is an RPSS, kind of starting just with the very basics of what is a pension, and then I'm going to go through the lifetime allowance and the annual allowance and the taper, and then talk about what is McCloud, and then what is an RPSS. So just to kind of give you the very basics of what is a pension. So a pension essentially is our deferred income. So obviously we get a salary from the NHS, and then at the time that we retire, we get some of that income back as deferred income. And it's a really, really important part of our remuneration package. But there's two different types of pensions, and I'm only going to talk about so-called defined benefit pensions. So in the private sector, predominantly, people have what's called defined contribution pensions, and they basically will put some money into a pot that's typically invested in the stock market, for example, or bonds, and their employer will also put some money into a pot, and then that pot will grow, and then at the end of it, they can either draw down some of that pot, or they can buy income or an annuity. Our pension is nothing like that. We don't have a pot, so to speak. We have a promise. And so that's what DB means. It means the benefit that we get at the end of it is defined. Now, because we don't have a pot, the government needed some way of assessing what the value of our pension was. And you might be asking, what am I talking about the lifetime allowance for? Because the lifetime allowance was essentially scrapped in the 2023 budget. But there are still some bits that are still worth understanding about the lifetime allowance. And of course, none of us know what is around the corner in terms of pension taxation. So basically, when you retire, you will have a pension, and you will have a lump sum if you've got any 1995 benefit. And then they will do a simple calculation of pension times 20 plus lump sum, and that gives a capital value at retirement. Now, when the LTA was introduced and initially index linked, you could save up to £1.8 million, pardon me, which is quite a generous pension. Now, not to say that you couldn't have saved above that. But if you saved above that, then that excess was taxed. And that tax was 25% if it's applied to pension, because of course your pension is subject to index income tax, and 55% if it comes out of the lump sum. And it sounds like there's a big difference between the two, but they're essentially equal, accounting for the fact that the pension is then subject to income tax after that. And the problem that we had, or the problem that the government had, was that most consultants and GPs and senior medics hit the LTA in their mid-50s, and then that was a very powerful driver towards either reducing the amount of work they did or early retirement. So one of the things that the government did to try and mitigate that was get rid of the lifetime allowance following extensive lobbying. And initially they got rid of the LTA charge in 2023, and then it's been completely scrapped through legislation from April 2024. Now there are still some remnants of the lifetime allowance. So for example, the maximum tax-free lump sum is set at 25% of the old limit, unless that is or was protected. And just worth reminding ourselves that the day that this was announced, Labour said the same day that they would reintroduce it if elected, and following lots of lobbying from the BMA and others, Labour kind of backed down from that, and it wasn't removed. So we're still in a position where currently we have no lifetime allowance. So basically it means that to be tax efficient, you've got to fill this jug, but once you overfill the jug, there is tax to pay. But then there was a secondary tax with something called the annual allowance, and the annual allowance is basically how you fill that jug. So again, back in the day, this peaked at 255,000 or 255 mils, and so it was obviously very easy with a large beaker to account for kind of fluctuating income, etc., to be able to fill that jug in a tax efficient way. But then that was reduced initially to 50,000 and then to £40,000. Now, as I explained, there's no pot, and unlike in the defined contribution or the private pension world, where annual allowance is very straightforward, it's just basically what you put in plus what your employer puts in terms of DB schemes like the NHS, there's no correlation at all between what you put in and what your employer puts in. It's just to do with what the pension is valued at each year and how that grows above inflation. So for example, if you get a pay rise, for example, following a period of pay restraint, and that is above inflation, then they times that new pension by 19, and that's how much your growth is. And then if that's above the annual allowance, then that is taxed at your marginal rate of tax, your normal rate of tax that you would pay for income tax. And then in 1617, possibly one of the most damaging and stupid pieces of tax legislation ever brought in was the tapered annual allowance. And that introduced two new concepts. One called threshold income, which basically is taxable income, but there's a few differences between taxable income and threshold income. And if your taxable income was above a threshold, which was then £110,000, then you then had to work out your adjusted income. And worth noting that when this came in 1617, 110 was about the medium earnings for a GP and a consultant. So lots and lots and lots of people were subject to the tapered annual allowance. So it was a big problem, and it stopped people taking on additional work, for example. Pardon me. And then so if you exceed threshold income, you then add in this random number generator growth figure to get your adjusted income, and then if that, it will then taper down your annual allowance from then 40,000 all the way down to a minimum of £10,000. Lots of pressure was put to bear by the BMA and others, so there was a compensation scheme to relax this in England and Wales, but sadly not Scotland and Northern Ireland in the 1920 tax year. And then in March 2020 they tweaked the taper by increasing those limits by £90,000, but the sting in the tail was that the minimum tapering was down to £4,000. And then in March 2023, as well as the change to the LTA, which I just described, they did increase the general AA from 40 to 60,000, and then subsequently adjusted income went up, and that minimum tapering was also relaxed. So I think one of the commonest misconceptions when I speak to people about pension tax is that the taper hasn't changed at all. Yes, the taper is still problematic, but it has changed massively. So this red line represents the initial position in 16-17, and that's obviously all relevant to McCloud. So when your adjusted income, and that's on the x-axis, was 150,000, you tapered all the way down to an annual allowance of only £10,000 at an adjusted income of 210. And then the orange line was the initial changes in the 2020 budget, so everything's moved over £90,000, but this minimum tapering affects at £4,000. And then the position after the most recent 2023 budget, it now increases to a general AA of 60,000. That means that slope is longer, so you're not fully tapered down to a restored 10 and not 4 until your adjusted income is over £360,000. And there's also been changes to something called negative growth, which is a kind of a technical thing that relates to whether or not your pension didn't go up to the level of inflation. So we're now giving credit for negative growth after the 23-24 tax year, which also kind of softens the impact a little bit of the taper. So now we kind of fast forward to why we're all here, and it's this mess called McCloud. So basically around 2010, Lord Hutton was commissioned by the government, who decided that public sector pensions were getting too expensive, driven largely by the fact that we were living longer. So people spent a high proportion of their time in retirement, and they felt that it wasn't financially sustainable. The government of the day probably wanted us to lose our defined benefit pension, but Lord Hutton felt that that was a step too far, and the unions wouldn't be very happy about it. And I think he was right about that. So the compromise was, rather than losing a defined benefit pension, we moved over from final salary to care or career average revalued earnings. And because they had this issue of us living longer, and so longevity being an issue, they also fixed it to state pension age. So that meant they could adjust state pension age without having to revisit the whole kind of pension question again. And because of these two things, and then a feature called the cost cap, which I'm not going to go into, which basically kind of guaranteed it would be fair to both taxpayers and workers, it came with a 25-year guarantee. Now, it's fair to say the cost cap probably isn't operating as intended, and in the last two valuations, where there probably should have been some increase of benefits to workers, government found some way of not paying that through one way or another. But again, I won't get distracted. It's probably also worth pointing out that Lord Hutton was a bright chap and warned the government that age discrimination legislation means that it's not possible in practice to provide protection from change for members who are above a certain age. Government ignored that recommendation, and it's because they ignored that recommendation, and then a very clever judge called McCloud sued the government and won, and then it went through various appeal stages, that we're all here and having to kind of fix this whole McCloud issue. So, sorry, I was going the wrong way. So this is McCloud on a page, and I apologise if this is a slightly busy slide, but the essence of McCloud is these three boxes at the top. So put simply, anyone that's eligible for McCloud before 2015 were all in our legacy schemes. That's the old 1995 scheme, or if you joined later, the 2008 scheme, or if you chose to move over to the 2008 scheme, that's your legacy scheme. So pre-2015, everyone's in that scheme. After 2022, we're all in the new scheme, the so-called reformed schemes. That's the care scheme with state pension age as the normal retirement age. So McCloud is this bit in the middle. So McCloud basically means that at retirement, and there was a big fight to make sure that people got this decision at retirement rather than early on, means that you can decide whether or not you want this 7-year period only in the old bit or in the new bit. So this is what happens at retirement, okay, and that's called deferred choice underpin. But they also had a problem with what to do now, and what they had to do now was what's in the red box. And to do that, they had to roll back everybody into their legacy scheme for this 7-year period. And I've already discussed that there's been loads of changes to pension tax in that 7-year period. And there's also this concept of in scope and out of scope. So what in scope means is that in the same way that you can amend your tax return for the current year or any of the previous 4 years, these are in scope years. But for the out of scope years, you can't adjust your tax return. And similarly, if there's an increase in tax in the out of scope years, the government have got no realistic way of asking you to pay that increased tax. So basically, in the out of scope years, any increased tax is ignored, essentially. Any overpaid tax is going to be refunded as compensation. And then in the in scope years, the normal adjustments are made. So we've got ourselves a bit of a mess. So we've got to revisit 7 closed tax years that either you will have done yourself or your accountant will have done. We need 5 years of data before that to make sure that people get their carry forward correct. Because of McCloud, they also delayed the 22-23 tax year. So already we're dealing with 13 tax years, so much more complicated than a normal tax submission. And then very stupidly, they decided to try and make all of this lot coincide with the same date in January as the 23-24 tax year. But of course, as many of you know, that 23-24 tax year was also just a complete mess, because following a free calculator that I released to try and help people work out their tax position because the statements were going to be delayed, it in fact transcribed that all of the PSSs sent out in England and Wales were incorrect for the 23-24 tax years. That's all still being sorted out, and people hopefully will have estimated what their pension tax charge was going to be. So just in terms of carry forward, really important to kind of remember, and just in general, that you should never just use the 3 years that are on a pension saving statement, and you should always go back to 10-11. So this was a tweet that I put out in 2019. Somebody was thanking me that their tax charge went down £2,400 by going back to the original tax year rather than just using the 3 years that their financial advisor had told them that they owed. So I kind of joked here, if your accountant or IFA offered to do your charge with just 3 carry forward years, you need a new accountant or IFA. But actually, HMRC and the Department of Health also made exactly the same mistake. So when we were originally discussing the calculator with them before it was released, I pleaded with them to make sure that they included all the correct tax years, which they didn't do. So then I had to show that you had different results using the existing annual allowance calculator and the new HMRC compensation tool. And grateful for them for pulling it very quickly and changing it. But you can see in this example here, the difference in compensation for that 1 year was £5,000 more compensation by using all the correct carry forward. So just kind of emphasises the importance of having an expert that uses all the data correctly to make sure you get exactly what you're due. So this is a big mess. So there's about 1 million affected members for McCloud. Obviously, pension tax only affects the higher earners, and based on the latest numbers from the scheme, they reckon 137,000 people should be receiving an RPSS. It's a little bit difficult trying to extract numbers from them as to how many are outstanding, and there's been differing versions that have even gone in response to ministerial questions over this, but we think that there are at least 30,000 outstanding, but it may be more or less than that. It's all just been a bit of a car crash in slow motion. So what I'm going to do now is go through my RPSS and the triage forms. I'm just going to try and hopefully change the camera, and then I'll kind of talk you through it. So I'll go through the triage form last of all. So the front 2 pages are just kind of general bump explaining what the annual allowance is, rather like they do on a PSS. Why we're sending you one, because you've exceeded the general annual allowance, and what it doesn't contain. So principally, we'll send you a 23-24 PSS later, and of course that was due in October, and we're now at the end of April, and I've not received mine. I suspect almost all of you haven't received yours either. So then moving on to the kind of PSS properly, this is a really useful page and table. So this is the kind of the core bit of it, where we've got both the new pension input amount, so this is after McCloud rollback, and we've got the old pension input amounts, so these are before rollback, and you can see on this page they're split into the 2 schemes, but it's different to that on the final page because they don't ask for the split amounts in the HMRC calculator. And we've also got existing scheme pays information, which is helpful if you've not got all your paperwork. Now, it's probably worth pointing out that I did ask SPPA to try and copy this template, which is the case for both England, Wales and Northern Ireland, because it's really useful to have the new and old pension input amounts, and they basically refused, saying they didn't need to, which is really unhelpful, because one of the things that the triage process asks you is have your amounts increased, and that's obviously much harder to determine if it's not there for you on a piece of paper. And similarly, the scheme pays bits aren't on there either, which is a bit disappointing. We've then got some carry forward years. I explained we go all the way back to 2010. This table has some use in that you can see I've highlighted the 15-16 tax year, and if you were lucky enough to have a pension of £1 million by the end of 2016, you could have applied for something called IP16, and you can work out what the pension would have been by dividing the closing value by 19 and then timesing it by that 23 figure to get to the capital value. So basically, if this number for you is above 826087, it meant that you could have applied for IP16, which had a deadline of the 6th of April 25. Now, we've lobbied quite hard about that deadline because of all the mess around pension saving statements and RPSSs, and we're expecting that to be announced, that hopefully is going to be extended to 2027, because even though the lifetime allowance has been abolished, there's still implications for your lump sum allowance. This page is not that helpful, and then we get to the summary page, which is the most useful one for triage. Pardon me. So if we go through the triage form, basically what the triage form is trying to do is ask you a series of questions that are asked on the HMRC digital service to try and work out whether or not you need to do a full calculation. So question 1 is, have you paid AA charges between 15-16 and 21-22? And you can see straight away for me that's a fail, because you can see I've got scheme pays there, so that's it, I've failed triage. And if you failed, you don't need to go on and answer any of the other questions. It's a straight fail. If you've not used scheme pays, you'll need to know whether or not you've paid HMRC directly through self-assessment via your tax returns. The next question, have your contributions changed, only affects locum GPs subject to something called annualisation, which is really rare. Question 3 is the one that I mentioned in relation to being a bit difficult for colleagues in Scotland, because you've not got the pre-rollback ones, but if any of your numbers go up, that's a triage fail. So you can see for me, I don't fail on that particular one, because all my numbers have gone down. 43 becomes 36, 51, 44, 37, 13, and so on and so forth. But as I said, I've already failed on the fact that I've paid pension tax, so therefore I've failed triage. Question 4 is a really straightforward one, and it's whether or not your pension tax was over £40,000 in the 22-23 tax year, that's a triage fail. Question 5 is your net income over 190? And they're trying to set a slightly lower bar to pick up people that are tapered and therefore might access, might have a charge to pay. And question 6 is kind of vanishing the rare stuff in the concept of the NHS. It's people that are saving into a private pension and have accessed it, and that's getting at something called recycling. But for the vast majority of people, that will not apply. So I'll just go back to the slides. So why is this important, and why are you here? And one of the principal reasons is unlike the dread that I certainly got every time I got a brown envelope, even though I knew generally what was going to be in my brown envelope because I could calculate it. But most people associate brown envelopes with pension tax charges. But this brown envelope is different and can mean that you're in for a substantial refund. And there's 3 principal reasons why pension charges are generally lower post rollback. The first is because we've had substantial pay erosion. So some of you may be familiar with the work that I do on pay, and so this is a chart based on the great John Murdoch from the FT, and shows our pay versus CPI inflation. The yellow box is the remedy period, and you can see that our pay was absolutely destroyed during the remedy period and went substantially below inflation. And as I touched on before, we've got this issue that negative growth was zeroed. So the combination of those things meant that when we go back into 1995 only, that is more beneficial than when we were in 2 schemes. The second reason is due to higher accrual. So the 2015 scheme pays 54ths, whereas the 1995 scheme pays 80ths. And this is another kind of gross unfairness in the way that annual allowance is calculated in DB schemes. Is, of course, we all know that it's not as straightforward as the 2015 scheme being massively more generous than the 1995 scheme, because they have different pension ages. So 80ths drawing at 60 might be broadly equivalent to 54ths drawing at 68, but the pension tax calculations completely ignore that. So this is another reason why pension growth comes down quite substantially when you roll back. And then the third relates to that chart that I did on tapering that showed with less severe tapering, you kind of get the double benefit, if you like. So if your growth comes down because of these 2 factors and then you're less tapered, then that can substantially lower your charge. Now, the caveat here is the word generally, and growth and indeed pension tax charges will not go down for everybody, and some people have new or increased charges to pay. I think it's fair to say, having seen quite a few of these now, that probably one of the things that we hadn't put on here is a significant reason for charges going up is that some people may have underpaid previously and just calculated it incorrectly. But in terms of pension growth going up, common reasons include being an MHO or mental health officer status, and that's for consultant psychiatrists. If that's not you, you can ignore that. The 2008 scheme is also more likely to go up through a combination of factors. Firstly, it's not just using pensionable pay, it's using some ridiculously complicated thing called reckonable pay. And the difference here is much narrower. So it's not 54ths and 60ths. Sorry, not 54ths and 80ths, it's 54th and 60th. And last but not least, if you've had a pay rise during the remedy period, the combination of having a pay rise and having more final salary linked pay mean that you might have more pain from a pay rise year than you would have had in the old system. But we also need to bear in mind, if we kind of think back to that slide about in scope and out of scope, where these increased charges may arise. So if an increased charges arises between 15-16 and 18-19, so that's 4 tax years, they're out of scope, and so that's essentially written off by government because they have no way of getting that back. If you're in England and Wales, we fought hard when the compensation scheme came out to make sure that the compensation scheme would essentially remain open for McCloud. So if you've got new charges and you're a clinician in England and Wales, then that's another year. So we're already 5 out of 7 years, essentially, where that tax will either be covered or written off. But for everybody in the 2021, 21, 22 tax year, then if there's an increased or new charge, that will be payable. And of course, it's probably worth pointing out as well that the 22-23 tax year has never been assessed. So if there's a charge in the 22-23 tax year, that's just because we were told not to put it on last year's tax returns, and hence it becomes payable as part of this process. So this was mine again, and you can see that, as I said, all of my growths went down, and so my growth was over £70,000 lower, and I've now kind of completed and come out the other side of the Forvis Mazars process, and I've got £32,000 compensation. And I'm using the word compensation a little bit loosely there because for me, mine was a mixture of paying cash and paying scheme pays, and that 32k figure is a mix of cash compensation to me with interest and cash compensation to the scheme. And I don't like the way they call it cash compensation to the scheme because it sounds like, well, why the hell are they paying the cash compensation to the scheme rather than me? But of course, that cash compensation to the scheme is paying off your loan, and in paying off your loan, that means your pension reduction is lower, and therefore your pension is higher. So that compensation is coming to you, whether or not it's paid cash with interest or whether it's paid to the scheme. Please do not ignore your brown envelope. Firstly, under the self-assessment rules, you've got a requirement to do something about it. They're not sending you for fun; they're sending you to act on. But the average compensation we've seen in many hundreds of these cases is over £14,000. But if you don't process this form or get somebody to do it for you, then no one is sending this cheque for £14,000 to you from HMRC. You only get it if you claim it. So what do you need to do? So just my last slide before handing over to Kieran. So you can, of course, do all of this yourself. So you can go to the HMRC digital service. The full service runs to about 200 to 230 pages, depending on things like private pensions, etc. It's really hard. And I have to say, when I was helping HMRC as a guinea pig, and their developer, who are Accenture, and there were 20 odd people kind of watching and recording me doing it, I made several mistakes just trying to transcribe all my numbers from tax returns, etc., into the tool is really difficult. So the tools that I've built with Forvis Mazars automate lots of that and do that robotically to make sure that it's all done correctly, but to make sure all the computations are done correctly as well. At the very beginning of the HMRC digital service, there's 8 or so triage questions, and they basically mirror that triage tool that I've already showed you. If you only need triage and you appoint an accountant, you can claim up to £250 back from the cost claim back service. However, if you get to this screen that says you are eligible to use the public service pensions adjustment service, that means you're going into the full tool, and then you can claim the full £1,000 Inc. VAT. So I'm going to hand you over to Kieran in reminding you of the pandemic. I'm doing the slides, so if Kieran just says next slide, and I'll do a bit of a Chris Whitty and advance them for you.
Yeah, hi everyone, thanks Tony. I assume you can hear me, Tony, can you now?
Yeah,
brilliant. Yeah, no, thanks. It was really useful just to listen through all those different bits and a bit of your your wisdom. Even for an accountant sitting here, it's quite nice to get a bit of a refresh on all that sort of stuff. So it's really useful. So yeah, what I'm going to try and do is to just give a bit of an outline of who we are, so who Forvis Mazars are, just explain a bit about me in case you're interested, and then we'll just go on over the next couple of slides. essentially just to look at the service that Tony sort of briefly mentioned that we can help you with. It's all hopefully straightforward from your point of view, guided through it. And as Tony said, the key part of this is that it takes the administrative burden, of entering figures and possibly getting them wrong away from you. So yeah, in terms of Forvis Mazars, so we're a top 10 UK accounting firm, and we're part of a global network of experts. So that's the benefits of a really big sort of global accounting firm, but also we're specialist medical accountants, and that means that we've got a team within a big firm, a smaller team of about 50 based in Manchester and Scotland, who that's all we do. We just look after medical professionals, be that GPs, hospital consultants, locums, salary GPs, and any other sort of medical professional within that. Sort of briefly mentioned it earlier. So ASMA, which you can see the long-winded version of it there, is essentially a UK network of specialist medical accountants, and we share information between each other, just try and ensure the quality within those accountants and make sure that best practice is used. So as a firm, Forvis Mazars, we act for over 300 GP practices and over 2,000 medical professionals, of which a large proportion of those will be consultants as well. And as I said, one of our key focuses, as a firm, is to support the medical profession, and essentially, that's allowed us to have this relationship and partner with Tony using some of the tools that he's built and the process that we've created. Yeah, and as I say, I'm a healthcare director, so sort of helping lead the team of about 50. Got 10 years medical sector experience, and as I've already mentioned, ASMA, I'm also a board member of those, and Next Gen committee lead, which essentially is a committee that we've set up to help the next generation of budding specialist medical accountants. So all of that hopefully gives us a bit of credibility, shows what we can help you with, what we do and who we act for. So yeah, next slide, please, Tony. So essentially what we just wanted to do today was really just take you through our process, and essentially it's a nice streamlined end-to-end process. So at the end of this, we'll show you where to go to sign up if you need help and if you want us to help you. And essentially, as I've already said, it takes that administrative burden off your hands. You're all very, very busy people, and the thought of sitting there, filling in 200 pages is probably not that interesting. And you could probably think about doing lots of other things in your spare time. So we can definitely help you do that, and obviously ensure the accuracy is there as well. And I think one of the main things is not just the administrative burden; it's the fact that you might be entering your data, think you're entering it correctly, but actually it's getting us, professionals in the accounting space to look at your data, review it, and complete the calculations, which, as Tony said, uses, computers, which, they're going to be 100% accurate. And obviously we then review the outcome of that to make sure that what we've put into it, matches with, the underlying data and the fact that, the outcome that's generated from that makes sense as well. So, it's not just using these tools, it's using our knowledge of the pension scheme and, the tax legislation just to make sure that the outcome makes sense and is what we think it should be. And essentially we just support you through the submission process. So, whether that's be the triage stage where you're determining whether you actually need to do something with your statement, further than just looking at it, and seeing the numbers. And if you do need to do the full submission, we obviously, as I say, calculate that and help you submit those figures and numbers to HMRC and NHS pensions, which then in turn allows you to claim your refund and any of the compensation that you're owed. Or as Tony says as well, it might actually be that you owe some tax, particularly for the 22-23 year, as HMRC actually recommended for that year that you don't include anything on that year, just because of the RPSS process and the fact that some of those numbers were going to be unclear or uncertain at that point in time. And last sort of point on there is, it's just sort of peace of mind in all your requirements being completed. You know, if there's anything else that you need to do, we'll tell you. You know, be that how might you pay the extra charges, you know, how the refund process works, and you can know that once you've been through the processes, you know, you're done. You've got a big tick on the fact that you've received your brown envelope. You know, that's all sorted, and you've had some, you know, good quality professional advice in doing that. So essentially, just at the bottom of this slide, is just our end-to-end process. So effectively, it's split into 4 stages. You know, I guess you could add sort of a further stage just at the left-hand side, being, you know, you physically signing up to the website and registering for our service. But what really happens is, in a minute, we'll show you where to go. Is, you know, you go onto our website. There's a form to fill in with, you know, a very much slimmed down version of any of the questions that HMRC are going to ask you. Fill in that and submit it. You know, there's lots of information and other FAQs on the website in case you do have questions about how it works, you know, anything that I might have missed, or, you know, there will be more detail on that. But essentially, we onboard you as a client. You know, a part of that, there's sort of ID checks and due diligence. And obviously, one of the key parts is having a letter of engagement in place to allow us to act on your behalf and you to be happy with the terms that's been agreed between us. So once we've done that, we then move on to the data collection and triage stage. So what we mean by that essentially is, for us, and we can do this on your behalf, is to approach HMRC and NHS pensions and ask for the data in a specific format, because it, you know, helps in the accuracy of the calculations and shows a summary of all of those affected years. Is we do that for you. So we'll approach them, request that information, and once we've received it, we process it to see whether you need to go through to the full submission. So that's stage number 2. And then for stage number 3 is essentially these are the more detailed calculations. So as we say, if you call it fail the triage process, you'll be needing to do a full submission, and there's obviously lots more detailed calculations. You know, it's essentially completing those 200 pages, which Tony's mentioned just a minute ago. And then instead of, as well as just completing those calculations, we also provide, a comprehensive report which sets out a nice summary of your position for those affected years, the overall refund or tax owed, or whatever the outcome might be, as well as step-by-step guides on things that you might need to do. And as I say, that might be how to complete scheme pays elections and the figures to include in those. So once we've sent that to you, you review it, make sure you're happy, and sign it. And essentially, once we've got your signed report back, we then submit it to HMRC for processing. They'll go away, and this is the sort of time-consuming bit from their end. Is it it can be anything 8 to 12 weeks, is from what we're seeing, for them to process the calculations and determine, agree your refund or payment, and then they'll write to you and confirm the amounts and how they're going to repay that to you or collect the payment for any tax charges. And then, the final stage of the process is, once we've completed the submission to HMRC, we'll raise an invoice to you, and then we'll help you through the compensation scheme for the costs, to recover our costs for our service. And we'll cover that a little bit more in a second. So should be everything on that one. So if we can go to the next one, please, Tony. So I've already covered this in a little bit of detail, but I thought it'd be quite useful just to give you a bit of an insight as to what the table in the report looks like. So this is just taking an example of one of the clients that we've helped within the some of the hundreds that we've dealt with. So essentially, the table on the right hand side is it's using the tools that we've got to populate this from the information that's been received from HMRC, NHS pensions. And so you can go through and check, does this make sense to you? Do these figures match the information that you've received, or for your tax positions and pension positions for each of the affected years? And as Tony said, there's 8 years in question, 9 years in question actually. So the 4 on the left, 4 on the right, and then just that single year on the right hand side of 22, 23. And then the lower half, the second half of the table, is the overall summary. So what we're looking at is a before position. So that's where you can see hopefully the previous annual allowance tax charges and the after position. So updated annual allowance tax charge, just that sort of center line where you can see the blue box, sorry, not the blue box, the red box is covering those couple of numbers in the middle. So essentially what it's trying to do is say, this is where you were before, these are the charges afterwards, and then the blue section at the bottom is comparing the two and determining what your refund is or the tax is owed to HMRC. And then right at the bottom of the table, we've got a summary position, and that's just hopefully in a nice, easy way summarising what's owed. So appreciate there's quite a lot of numbers in the table. If you're just interested in the overall outcome, this shows you in this example, just under £1,200 will be paid to you in cash effectively, and then just over £15,000 will be paid back to you as a refund to your pension scheme, because the scheme pays election or scheme pays elections would have been used. And then, as we've already said, for the 22-23 year, a number of cases that we've been processing and calculating, there are charges for the 22-23 year that obviously haven't been reported, and that's just summarised in there. So, this is quite a nice example, because between the two, the compensation which is owed and the tax charge which is payable to HMRC, the overall net is about £14,000. And as Tony says, that's about the average refund of all of the people that we've helped, which is obviously a nice sizable sum. Yeah, on to the next one, if that's okay, Tony. So we've said, we complete the calculations, guide you through the process, and obviously as part of that, there are fees that we will charge for that. And I'll come on to those just in a second. But essentially, our fees are fully covered by the cost claim back scheme. So none of this, all of the McCloud rectification process, this is all, it's not your fault. It's been caused by the way in which the government created the pension scheme and the way in which you transitioned into the 2015 scheme. So effectively, because it's not your fault, there's these amounts of compensation for professional costs that can be paid back to you. So essentially, what we really need to know is the second and third sort of bullet point there is £500, including VAT, can be paid at retirement when you choose between where you wish your benefits to sit. So be that in in the new way of doing things, which would have been the 2015 scheme, or the old way, as if this had never happened in the 1995 or 2008 scheme. And obviously, at some point in retirement, you will be presented with the two options and can choose the two, and you're allowed £500 for the advice on that. And then for this, so this is the £1,000 including VAT for the rollback. So essentially the recalculation of those affected years where the HMRC service is used, is you can claim that back from the cost claim back scheme. And then for the triage process, as Tony has already mentioned already, up to £250 including VAT for that. So, it might be that's a relatively straightforward thing to do. But again, it requires knowledge of how the tax charges work, the information, of your pension history and tax history. And again, you can get some professional advice and have that covered for you. So yeah, just on to the next one, please, Tony. Okay, so now we sort of set out the compensation scheme available. It's just summarising our fees. So triage only, just for seeing if you need to use the full service or not, is £240 including VAT. If you fail that, as we've already said, you go on to the full calculations, and that's the £1,000 including VAT. So looking at the figures on the slide before compared to these, essentially you can have us complete the whole process for you, and it's completely free of charge essentially to you. The only gap is that you need to physically pay the amount out to be able to reclaim it. You have to prove that to NHS pensions. So there might be a short period of, let's say, 2 to 4 weeks where you're out of pocket, but then that will be fully refunded back to you. And as yet, because of the way in which the process is being completed, the fact that we help you claim the compensation, we'll send you a part completed compensation scheme form, is we haven't had any rejections in terms of the compensation scheme yet. So I think we can fairly be safe to say that, you know, we can do this, you can claim it back, and then you get the money in 2 to 4 weeks after you've paid the invoice effectively. So just on to the next one, please. So essentially the two QR codes on the right hand side. So the first one, so the one in the middle, that will take you to our website. So that will provide you with all the information over and above what we covered today. So lots of sort of FAQs on the technical side of things, but some more detail on the actual process itself. So a bit more information compared to what I've told you. And that will then include a link to the overall assessment form, and that's the one on the furthest right hand side. So if you're, you know, let's say you were happy, you know what you're signing up for, the one on the right hand side would be answering those questions, so some of the key questions, completing that, and you're effectively registering your interest with us. Once that comes through, you know, we'll guide you through the process, tell you what's needed, and get you signed up as a client if that's what you wish to do. So some of the questions that we've had, you know, throughout this process is all about the deadline date of the RPSS forms and statements. So up until before 31st of January 2025, there was a deadline of the greater of 3 months from the date of your RPSS or the 31st of January. So given that the majority of the first batch of statements were issued in early October, some at the end of September, you know, the deadline for the submission of those would have been 31st of January. We're obviously past that date now, but we know, obviously aware that lots of affected members are receiving statements now. And so effectively the deadline is 3 months from that date, but HMRC have confirmed informally, so they've not written it anywhere, you know, but it just seems to be part of their process, is that they're not charging interest, or should not be charging interest, and should not be charging penalties. So it's really should be a deadline to drive completion of the forms, and there hopefully should not be any consequences to missing that deadline. Of course, if you're registering now, you know, the process will be completed by the end of the 3 months anyway, so you wouldn't need to worry about that. And then, you know, if for whatever reason you're receiving your RPSS at a later date from now, there's a key deadline here, which is 6th of July 2025, and that relates to the payment of any increased charges through scheme pays. So that's obviously a key deadline, is that needs to be met to allow your pension scheme to paying those or any of those tax charges. So essentially, as soon as you receive your statement, you really need to do something, because it might be that you have a new charge and you need to consider how to pay that, and that may be, if that's preferable for you, using the scheme pays election. Something else as well, Tony's already mentioned it, is the 1920 compensation scheme. So any tax charge for the 1920 year, that can be covered in full. Obviously, Tony said England and Wales, you know, by the NHS, but the way in which you access that is by completing a scheme pays election, and there's a 6-month deadline from the RPSS date to complete that. So again, you know, it's one of these things which is, you get the envelope, you know, it's much easier to do something about it as soon as it comes through, rather than sort of filing it away and thinking about it at a later date, because these deadlines can soon pass by, and there could be quite substantial consequences for missing them as well. So yeah, I think we'll probably answer a few questions now. Is that right, Tony?
Yep. So we're about 54 minutes in, so we'll spend kind of 5 or 10 minutes just answering some questions. And if you're subscribed, if you want to put any questions in the YouTube chat, you can do as well. So I can take this one, Kieran, or you can. So Anon asks, has anyone had 0 input for a year after adjustment? My 2020-21 shows nil input. How is that even possible? Do you want me to answer that, Kieran?
Yeah, if you like. Yeah.
Yeah. So this kind of, I'm going to just kind of go back to one of my slides actually. So this kind of comes back to how annual allowance is calculated, and there's this kind of random number generator bit at the top where they look at your pension and see how it is in relation to inflation from the previous September the year before. So in the old scheme, pre-rollback, people had final salary linked pension and they had 2015 pension. Now the 2015 pension always goes up every year. You always have growth in that because that's based on 1/54th, and so your growth is going to be around 1/54th your pensionable salary times 16 plus a little bit for revaluation. The 1995 pension works completely differently, and it's all about what your pension looks like compared to the year before and whether or not that's above inflation. So you may have had a position before you had growth in the 2015 scheme, because you always get growth in the 2015 scheme. But then if your pension hasn't gone up above inflation because we had lousy pay rises during the remedy period, I showed you that graph showing the pay, that means that your growth could be zero. Now, the fact of the matter is that there's no real thing is zero growth. What was actually happening is your pension was actually going down in real terms. It was negative growth. So I and others have been kind of, campaigning for 7 or 8 years about this whole issue of negative growth, which I used to tell government is what I called pension theft, because essentially they were taking money from you by not giving you the credit for your pension going down, which was absolutely scandalous. So from the 23-24 tax year, thankfully that changed, and now they're accounting for negative growth. But during the remedy period, zero just means that your pension went down, basically. And all of these are reasons why generally people will get compensation, because the growth goes down when people are rolled back. So the next question is a nice accountant one for you, Kieran. Greg asks, I work part-time NHS and I'm 59 years and have a SIP as well as my NHS pension. I never got an RPSS and phoned this week after waiting for months. I waited 20 minutes to speak to somebody, that's not bad. The chap said you won't get an RPSS because there is no overpayment. I think rather than overpayment, he means that it's not exceeded the general annual allowance.
Yeah.
This after reading in various places that everyone was going to get one. So what do people do for planning around things like whether or not they can safely pay into a SIP?
So, I mean, obviously, in terms of the RPSS statements, is the default position for those essentially is you're only going to be sent one if you're one, eligible for McCloud, to have exceeded the general annual allowance within the remedy period, which obviously is the 2015-16 year to effectively the 22-23 year, or if you've ever requested a statement. And I mean, the fact in this one as well is that if you've been contributing separately to a private pension, then there is no way that NHS pension is going to know, in terms of your overall pension input amount. So effectively, the growth in your pension plus what you've been contributing, because you could have easily been under all of the thresholds throughout, but obviously you've been then topping it up and making contributions to the side as well. So, I mean, essentially, the way in which all of this works is that all of the statements are going to be sent out to those affected people or those people who meet those criteria in the first instance, and then you can request one if you aren't within that group, and that might be this person. So essentially they would need to go and request one, and essentially do that in the same way. And I think, Tony, you've got a bit of a link in terms of how to request that from NHS pensions, which I guess we can probably put in the chat at some point, can't we, just to make sure?
Yeah, that's right. So we're into something called on-demand statements. I've been saying for many years that my preferred position would be for NHS pensions to send every high earner a pension savings statement every year, but sadly they don't. So that means if you're a high earner and you've not got one, or you're not going to wait and find out until they send you one, I would just request an on-demand one every year. And I'll try and put the link in the chat if I can, but if you want to request an on-demand RPSS, if you go to the URL bit.ly, that's bit.ly/NHSP04, that is a URL that will give you the template to request one on demand. So CB asks, and I get this asked pretty much every day, any advice if still not received an RPSS? So I'll give you my personal take on this. This whole process has been a complete car crash from beginning to end. NHS Pensions said that they were going to start sending these out in April of 2023. The statutory 2024, sorry. The statutory deadline was October 2024. We're now 7 months beyond or more beyond the statutory deadline. So my personal view is, if you were expecting one and haven't got one, I would write to the scheme and ask them where it is. And there's a number of reasons to do that. Firstly, BSA have got many thousand that they say they don't have contact details for. So they may have done your calculations, but they can't send it to you because they claim that they've not got an address for you. So if you email them and ask for it as a PDF, you'll be able to get your number straight away. But some people, and most notably GPs, also haven't got them because their employer record is not up to date, because they have to deal with PCSE and Capita, and as GPs in England know that is sometimes problematic. So I would use that template, so that bit.ly /NHS P04, and that basically, as well as asking for your RPSS in PDF format, will also ask them to confirm whether or not they're waiting for employer data, or whether or not they need to do a so-called manual calculation. So roughly 20% of people fall out of the automated process, need a manual calculation. But in any event, just giving you the standard rubbish answers that everyone's going to be sent one by X date, I'm afraid is completely unacceptable when we're more than 6 months after a statutory deadline. NHS Pensions need to do better, and the bottom line is NHS Pensions, the staff that they've got are very good, but there's just not enough of them. It's woefully underfunded, and massively underfunded compared to peer public sector schemes. And so, with my BMA hat on, one of the things that we push for every day is for the scheme to be funded much better for admin, because admin is a complete car crash, and none more so is it a car crash for higher earners who've been massively discriminated against with all of this mess with pension taxation. So next question, Anon asks, and this is a good one for you, Kieran, probably.
Yeah.
I've seen some accountants check the information with HMRC. Could you cover what information this is, and why that is better / needed?
Yeah, sure. I guess I've briefly explained, an accountant's approach in terms of approaching HMRC for the data that covers the relevant years. So essentially what you can do, what we can do on someone's behalf, or actually you can do individually, is ask HMRC for a detailed extract of your relevant information for the years that are affected. So essentially they would send you an Excel spreadsheet with a table covering lots of different columns, lots of different numbers for all of those years. So that's really an easy way of just getting a summary of that data, because otherwise, and it goes back to the completion of the forms, and the 200 questions or whatever it might be, is you would need to go and draw that information out of 7 or 8 years tax returns. That's very difficult to do, knowing which figures to take out, knowing which ones are needed. And obviously, as we said, the accuracy of those is very difficult, especially if you're having to take it out of something, summarize it, and then input it into something. So HMRC send you a summary of what they've got, and you can use this to complete the calculations. Essentially, we have seen this in to be fair, quite a number of cases actually, is that the information in the tables coming through, particularly where we're completing calculations for our clients, differ from the underlying information that we would have submitted on their tax returns. Which is a bit tricky, a bit disappointing as well, because obviously that creates a lot of extra work, questions back and forth to that person, understanding their position, when actually it might be that HMRC have incorrectly extracted it, typed it, whatever it might be, and it's just an added layer of, I suppose, delay and frustration within this process. So yeah, essentially it's, why is it better for an accountant to check it? Is it goes back to all of the things we were saying earlier. It's that sort of peace of mind that you've got your details, you've got your data. Someone who knows how to interpret those and understand if things are wrong, they can ask the questions and complete it properly on your behalf. And as we've already said, there is funding available to support you in completing those calculations, or for someone else to complete those calculations for you. But yeah, most important bit is it's time. It's really difficult to find that information, I think.
Yeah, I think the only other thing that I would add to that, Kieran, is that the data that we're getting from HMRC is the data that HMRC are using to check your submission. And so we know that HMRC know that lots of people got this wrong initially. So, so for example, people mistakenly taking gift aid or threshold income to try and get under the threshold income level and then paying the incorrect amount of tax. I've seen loads of experts get that wrong. And so HMRC are trying to build up a detail. The reason why it asks many, many more questions in this calculator rather than, for example, the HMRC annual allowance calculators, they're trying to build up a really detailed position to check that your sums are correct. And so I would always say it's best to have the data that HMRC are going to use to check your submission to try and make sure that it's right first time. Acknowledging what Kieran said is that even some of the HMRC extracts have had erroneous data on, so it all needs just kind of looking at and sense checking. Kate asks, I'm just going to change camera, can you explain step 3 in triage? So step 3 was simply, are any of your contributions higher in any year during the remedy period? So if you're in England and Wales, you've got the old amounts and you've got the new amounts. If you're in Scotland, unfortunately, it's much more difficult to do this bit. And all I'm doing is I'll just remove this blue bit so you can see it a bit better. So I'm just seeing whether these amounts have gone down. So 16 to 14, no, that's gone down, so that's fine. 45 to 40 has gone down, that's fine. 88 to 84 has gone down, so that's fine. So all of mine go down, so I don't fail triage on that particular point. But if any of your amounts go up, then that's a triage fail. So hopefully that explains.
Stage, but actually it still might be that you've not completed your obligations fully. And I think you mentioned it earlier, which was if you've never reported a tax charge to HMRC because you didn't know you needed to, or didn't know how to calculate it, this is really good. No one wants to pay more tax, but it's paying the right amount of tax and paying the tax that you should. This is a very good process to make sure that everything, all your sort of history with HMRC from a pension side of things is ticked off. And particularly, with the triage point of view, is you could actually go, yeah, I'm fine, but you may be missing tax charges, that you do have to pay over. And so, getting someone to look at that as part of that triage process, it would identify that, and then it might be that you then need to go through and do something else. So, it's better to make sure everything's correct than missing, and for HMRC to come sort of knocking and saying, we think you should have had a charge for that year, particularly as Tony said, they've got the data to do it. Just thought I'd add that in.
Yeah, I think Joe is kind of asking a question about his personal position. Might be a bit too complicated. Let me just read it. Thanks for this. I've recently got an RPSS, previously not affected by AA, nowhere near threshold for tapering. I started as a consultant in May 2020 and now seem to have 1995 growth, over 100k for that year. Yeah, so without going back to the slide now, but one of the things that I mentioned is you have more final salary linked pension. So that means the effect of pay rises is greater because you've got more 1995 pension. So the effect of the pay rise is higher. That's not to say that you necessarily have a charge, even though because your growth is higher, and so that's exactly why you need to kind of go through the full motions of doing all the calculations and seeing if you have an issue, because typically it's quite normal for going from a registrar to a consultant to have really high growth in that year, but generally, because of the much lower earnings in the registrar years, you have a ton of carry forward that might get you out of jail and then there's no charge. But you fail triage because your growth has gone up. Pay an accountant to look at it and sort it out for you for free. So I think we've gone 10 minutes or so over. So I think I'm just going to thank Kieran very much for his time,
Right, thanks, Tony.
his expertise on a Sunday night when I'm sure he's got other things to do with his young family. As Kieran said, FAQs are covered on this QR code here that just kind of describe the service. And then if you want to sign up with no obligation, if you just use this QR code on the right, put a few limited details that just kind of helps us kind of pre-triage you, and then we can get the ball rolling. And importantly, as Kieran said, all of the fees are refundable in the cost claim back scheme. So you've got the opportunity to get 2 expert accountants to look at your position and sort it all out for you. Make sure you get access to all your compensation, and for this year only, there will be no fee. Obviously, in subsequent years, if you use an accountant, the normal fees will apply. So thank you very much, everyone, for your attention. For people that missed it, it will be on YouTube, so people can catch up with it later. Many thanks, everybody.